So we'll try to keep this tight and maybe leave time for a few questions at the end before they turn off the lights, kick us all out. When somebody asks you what's a treasury company, well, a treasury company is a corporation that's capitalized on digital capital that issues securities against the underlying digital capital. Why is it it is a new class of finance company, a new type of company. There's insurance companies, there's banks, there are fund companies, there's finance companies, there are REIT, real estate development companies. There's plenty of types of companies and there's operating companies. Why is a treasury company new and different? It's because the Investment Company Act of 1940 prohibited publicly traded companies from capitalizing or leveraging on securities portfolios. That's why there's never been a Mag 7 treasury company, there's never been an S&P treasury company. You can leverage and you can 100%, this is why Warren Buffett has to sell Apple stock. This is why the Berkshire Hathaway portfolio of securities stays below 40% of its liquid assets. That's why he has so much treasury bills. The Investment Company Act created a carve-out for sovereign debt of the United States government. And so even though those are technically securities, they're deemed to be not securities or commodities for the purposes of the SEC 40 Act. That being the case, for any of these strategies to work, you have to go to 100% or more leverage. If you're only holding 10% of something, it's not enough exposure to make it a type of company. So the treasury company was born with the arrival of digital commodities, and specifically Bitcoin, the digital scarcity. You could lever a public company on gold, but gold is not exciting enough. 99% of investors don't think gold is a good long-term asset. It kind of tries to keep up with the S&P, but as a practical matter, to break through a new thing, it needs to be an order of magnitude better. And so because Bitcoin has been able to outperform the S&P by 3 or 4x, it's enough better that you could justify taking the risk on a brand new revolutionary thing. So what you see is now the rise of 180 public companies capitalized on Bitcoin. You also see an explosion of digital asset treasury companies based on Ethereum and Solana. Why? Because they're de facto being deemed commodities by the current administration. So they have de facto commodity status. If any other token were deemed a security, you couldn't pursue this strategy. That means all told, you got about 250 companies that are digital asset treasuries. And and you would say, well, can I do it with gold? Not really. Gold's too slow, too boring. Real estate, you've got REITs, but real estate underperforms the S&P. Soybeans, oil, people tried all sorts of things, but at the end of the day, if you've got a digital commodity which outperforms the S&P, you have enough performance to create a treasury company. Now the issue is, how will the industry develop? And we're in year 1 of this thing being birthed. And of course, 90% of the investors don't even believe it's a category. They don't even recognize it. 1% are enthusiastic about it. 2 or 3% are stumbling around. And with that as a preamble, I guess, Mark, what are your thoughts? What do you think is going to happen in this industry? And what are your opinions of treasury companies in general?
Well, I'm generally favorable of them. But as far as what I think is going to happen, I mean, we're trying to think into the future. And I think, unless you're Michael Saylor and you've studied the history of technology as well as read the fantasy books, it's hard for most of us to see the future. But when we have a new asset like Bitcoin, that's the digitization of capital, and it moves at the speed of capital, we have a new set of building blocks to build new things. And so we can kind of think about the financial system as we have today and then how this transforms it. And so we can kind of think about maybe what doesn't survive in the financial system and maybe what moves forward in the financial system. And so if you think about the $700 trillion sitting in the financial system that's earning somewhere between 0 to 8% right now today. But we can take this digitization of capital and then we can slice it up, as Saylor showed us, with different types of preferreds and different types of instruments that can provide something. As he said, typically treasuries have sat in that spot. We have 250 million people in the developed world right now, retirees, depending on some source of income. Again, $700 trillion of capital sitting on that income. And it needs better income, better yield, something safer than bonds. And so this new asset, this new digital asset that moves faster, that gives us this better CAGR, that gives us that room to then leverage into the S&P 500 and leverage into the debt and credit markets, it allows us to do these things. So I think some of the types of new financial institutions that we see kind of getting built on top of this are sort of interesting. Like, obviously, we're still going to have creators creating more than they consume, and there's going to need to be savings. So there's going to be financial institutions that will handle security, that will handle custody, and things like that. I think we'll always have a need for credit. So we'll have financial institutions that are still providing credit. People are still going to need to buy houses. They're still going to buy cars. We're still have entrepreneurs that need capital for businesses as well as scaling businesses. It'll be, as Mises would call it, commodity credit versus circulating credit. We'll be issuing credit off of savings. It's not just conjuring out of thin air. I think insurance is going to be a very interesting financial model in the future, specifically with Bitcoin. Warren Buffett showed us the power of having a float with insurance companies. So imagine if you're good at adjusting risk. If you're good at writing risk, you get the power of the float, put that into a Bitcoin standard. I think that's pretty powerful. I think about liquidity. So Bitcoin is, of course, peer-to-peer electronic cash. And so like I could peer-to-peer electronic cash with any of you here, and that's great, but if you're Walmart with 10,000 stores globally doing $680 billion, peer-to-peer electronic cash isn't really working. So you're still going to need payment providers, you're still going to need to pay hundreds of thousands of employees, you still need payroll companies, so a lot of financial institutions in that space. And then ultimately, the last category, I still see, I think, a lot of improvement. I think where these treasury companies move into this financial future is securities. So we're still going to need, companies will still need to raise money, we'll still need to bundle the money, we'll still need price discovery in the markets and things like that. But the difference is that we've had, this equity security market for 430 years built on fiat. And I think it all just transitions over to Bitcoin, moves faster, it's stronger, more transparent. And so really what happens is the Wall Street, the financial institutions are still there, but the Wall Street scaffolding that we have today is mostly collapsed. Things move faster, more transparent, and on a Bitcoin standard.
Brian, what do you think?
Yeah, from my perspective, one of the things I find very interesting is 13 years ago when I got involved in Bitcoin, there was a concept that I discovered that really inverted my thinking around the opportunity for investing and changed my mind around it. Historically, you have the protocol layer and the application layer. And the protocol layer would be things like IP, Internet Protocol, or HTTP, or SMT for Simple Mail Transfer Protocol. And you could never buy a chunk of that to monetize off its growth and adoption and value over time. You had to invest at the application layer, which was businesses like AOL and Yahoo and Google that had these different providers, and you monetized off that. So all the value accretion occurred at the application layer because we didn't have the chance to buy in at the protocol layer. Then, when blockchain and Bitcoin was developed, that investing scheme got inverted, right? We can now buy a chunk of that protocol and we can own it and hold it. And if you look at the return profile over time versus owning the protocol layer compared to owning the applications built on top, the protocol layer has significantly outperformed the applications. Now with Bitcoin Treasury companies, what we're seeing is a merging of both of those things together. We're getting exposure to own the protocol layer with the bridge that is the Treasury company itself. And I think that's a phenomenally interesting idea for where the future is going to go for these financial institutions. And the outperformance opportunities with that, I don't think we've even seen the beginning of where that can go. And if we think about it from a systems perspective, when you have an old failing system, i.e. our traditional fiat banking system that exists today, these systems are not going to just naturally adopt Bitcoin because it's going to disrupt their own business models. So what happens? You have to build the brand new system on your own so it disrupts those models, and then they are forced to adopt it over time. And that's what we're seeing with Bitcoin Treasury companies. And I think as we think from a future-facing perspective, and I agree with everything that you noted about the different types of products that can come into it, but what about the markets that don't even exist yet and how Bitcoin Treasury companies can engage with them? So let's walk through an example. Think of artificial intelligence virtual agents, right? Every time we question Grok or Perplexity or ChatGPT, there is an electricity and computational expense that's required to query that for it to process the data and information that comes back to us, right? Eventually, we will have a virtual economy of trillions and trillions of artificial intelligent bots doing things that we aren't even aware that they're doing. Right? And there's going to be a computational and electricity expense with those bots doing that labor. Well, they can't set up a Bank of America account. What can they accept? They can accept something like Bitcoin. So what if maybe the future of Bitcoin Treasury companies, one of the products and services they provide is to serve the ever-growing adoption of the artificial intelligence market by providing financial services and products in an internet-native way. So I think that's an interesting thing to think about in future as the years to come.
I think it's interesting to think Bitcoin is the protocol. And when I look at it, I think that's my risk. If you're a Bitcoin maximalist, that's your risk-free rate. And so I think it's like 29% a year for the next 20 years. That's if you want to buy the protocol. And if I want to invest in anything else, it's got to outperform that by a large margin. It's got to, it's got to be like 40% a year or 50% a year. And so the Bitcoin Treasury companies create things. Security is an application on the protocol. IBIT is an application on the protocol. MSTR, STRC, they're $1 billion, $10 billion, $100 billion application of the protocol. They move. People kept waiting for it. Well, how do we get a circular economy, and how do we get people to spend Bitcoin? Well, $3, $4, $5 billion a day trades in 6 hours in the layer 3, application, like on MSTR, or $4 billion or $3 to $4 billion in IBIT trade every 6 hours. So those the protocol is being fed by the applications, and I think that'll continue, and people are going to invent them at a ferocious rate. I think since this is the session of the day, I'd like to throw open the floor to questions for all of you. So maybe you guys could go around, and anybody who's got a question for any of us about Bitcoin Treasury companies or approaches or what they think will happen, feel free to throw it out, because I think we can make this interactive. I think for sure, there's the question of which will be the first bank that plugs in Bitcoin, what will be the first insurance company, the first reinsurance company, what happens when you plug this into a company like an Apple or a Microsoft or a tech company, what happens when a government prints its own currency to buy Bitcoin, all of these companies, what happens when a city does it or a state does it. The way you're early is you haven't had a city sell a bond to buy Bitcoin. You haven't had a state finance with Bitcoin. You haven't had a country do it yet. You've had a few companies and people. We have yet to get a positive article in the Wall Street Journal after 5 years. Like I'm going to declare success when we get one article that's positive. Like Bloomberg said some positive things. But we're still very early, and the next 10 years will be, again, it's like the gold rush, but imagine the petrochemical industry in 1870. And and you're looking at plexiglass today and nylon and polyester and the like and lycra, and what were they thinking in 1870, right? Who's got the first question? Go ahead.
I've got the first question here. So, Michael, this might be a tad premature and self-serving in some sense, but if you are president in 28, I'm lobbying for OMB director, and I had seen David Foley here. I put a bug in Larry Lepard's ear as well, that the broader implications. And I joke, but for those of us who number go up is nice, but we got here through kind of being pissed off at the the current system and the GFC and everything we've seen. So, maybe we did come here for number go up, but, we're here for the revolution now. So it was more just nice to, be here and be hanging with our people today. So I guess there wasn't even a question there.
Thanks.
Thank you.
That was an easy one.
Next.
Yeah, some of the recurring themes today have been kind of staying in your lane, keeping it simple and transparent for your investors, but also maintaining that leverage. In the example you used, Michael, was Standard Oil was producing oil and had a runway before the car was invented, and that really spurred that next use case for the oil products. In your mind, what is that next use case going to look like that transforms the marketplace as we know it?
I think the initial use case is digital equity, right? Equity. Levered equity on Bitcoin itself, and people are getting that, and Metaplanet just sold $1.4 billion of it last week. So that's kind of proof that there's a market there. The next use case is credit, and we saw convertible bond credit. That, we became the largest convertible bond issuer in the world. And I would say after my last 20 deals or 20 credit deals, if I was giving advice to a Bitcoin Treasury company, I would say you ought to sell an equity which is amplified Bitcoin, try to get to 2x Bitcoin, and you ought to sell a simple credit instrument like a preferred that's a Treasury preferred stock, variable yield on top of a currency. Pay 400 basis points more than the Swiss franc risk-free rate, or pay 400 basis points more than the risk-free rate in Europe, or 400 basis points more than the JPY yen rate, or 400 basis points more than SOFR. Go do that. Strip the volatility, strip the duration, strip the delta out of the instrument, and just, if there's anything that equates to gasoline, kerosene, like pure, highly refined crude oil, the equivalent of kerosene in our industry, I think, is pure credit spread, no risk. Like just 500 basis points, no vol, no risk. It's like when I asked everybody who's got a bank account, everybody, do you want your bank account to pay you 10% interest? Everybody. So a perfect, it's not the only model. There's 1,000 models. And so I don't want you to think this is the only one, but like I would literally say to someone like a MetaPlanet, sell MetaPlanet as 2, 3, 4x Bitcoin, sell Meta Yield as 6% in yen. That can become a $1 trillion company, and you don't need any other idea because you're just fixing the entire money market in that currency frame of reference. So I think if you want to be very simple, it's just extract the pure yield, throw away the credit risk and the volatility if you can pull it off. And that's the last thing I did after 5 years of doing other stuff. So I'm just kind of saying you can skip my life. Like the negative of starting now is, oh, you're later than us. The positive of starting now is you get to skip my first 4 years of mistakes. And I just gave you the answer. If I could fast forward and do again, I'd be like, I'd skip everything. I would sell stretch. I would keep the equity. And I would focus upon selling that Treasury preferred stock to every insurance company, every credit investor, every retail investor, plug it into every bank. Now again, I can't tell you I'm sure it works forever in 10 years. If it did work and we're back here, then I could say it works. Right now, this is my opinion. Next. Yeah.
Hi there. First of all, a massive thank you to everyone in the room for such a great vibe and for such enriching conversations. The question I have for the panel is, as I've been trying to orange pill people and the family office I'm responsible for, I think one question that I find very hard to answer is, stretch, strike, they're all great, but in terms of payment of dividends, what about operating cash flows? How sustainable is it? Will the Bitcoin will need to be sold at some point? So how would you advise me to address that question bang on so that it's a no-brainer?
Yeah, I think the answer is the Treasury company is sitting on a mountain of hard assets. In a rational market, it'll just sell the equity to pay the dividend. In an irrational market where the equity decouples from the Bitcoin fundamentals, you're going to sell the Bitcoin volatility, or you're going to engage in derivatives trading in order to extract the yield directly from the Bitcoin. If necessary, you're probably going to sell a future, right? You're going to sell an out-of-the-money call option against the Bitcoin, or you're going to enter into a basis trade. And in the worst case, you're just going to sell the underlying Bitcoin itself, because as long as Bitcoin is growing at a multiple of the underlying dividend, you always have that as a final option. By the way, the reason that you don't immediately go there is the most tax-efficient thing you can do is sell the equity. When you sell the equity, there's no tax. We could generate billions of dollars by selling derivatives on the Bitcoin. We generate a taxable event, and so we don't do it because it's just not as efficient, and it doesn't expand the capital structure of the company. But if somebody says, well, how are they going to pay the dividend? The answer is you're going to sell the equity. Well, if you can't sell the equity, then the answer is we're going to sell derivatives on the underlying Bitcoin itself. And that market has got there's $60 billion of liquidity in Bitcoin. So if you can't sell the Bitcoin derivatives, which is a very healthy market, you're going to sell the Bitcoin into the market.
Go ahead, Mark.
I was going to say, if I could just add on to that for a second, I would also just sort of challenge you here, Saylor, talking earlier, just now about 10 years. I'll be back in 10 years. I'll tell you if it worked. Earlier today, he was talking about, I can't tell you about 15, 25 years. I'll tell you about 10 years. So right now, we have this massive disruption with AI, and all the business models as we see them today are being disrupted. And so the traditional model is we'll pay you back with future cash flows. Okay, what future cash flows? In 10 years, you're still going to have future cash flows versus sitting on the assets. So, right, most people are paying you back on a promise, a future that'll have those cash flows with no guarantee because you have no assets versus actually having the asset base today. He's given you lots of other ways he can pay the dividend. Worst case scenario, we don't come to that, but worst case scenario, you have the asset. And so I think it's a different way that it's being done today because we have this new asset, right, financial capital. But that's how I would sort of address that.
One thing I was going to layer on too, because I meet with family offices all the time, and one of the things that helps, I think, them understand when you're advising them is not only are you walking through the mechanics of what Michael and Mark just laid out from like a cash flow perspective, a dividend perspective, but you also have to get them to understand the value of network effects, right? And so when you look at things like Metcalfe's law, where you take the number of users in the network and you square it and you multiply it by the transactional value flowing through the network, and you extrapolate that over time, you're seeing that you're going to have this asset that you're going to hold on to as the adoption rate continues to grow that is going to astronomically outperform basically anything else that we're seeing in the world right now. And so when you really help people wrap their head around from a family office perspective, not only is it a sustainable business from what they're doing in the public markets, but the very base foundation of their business, which is the acquisition and reutilization of Bitcoin and how that gets adopted and the network grows over time with an exponential growth curve, that's just going to impact the stock as well. And so I think that helps them kind of wrap their head around it. Not only is this cash flowing business doing XYZ with these different products that are Bitcoin denominated, it's moving that network adoption along its path as well.
Mark, Brian, pretend he's not sitting next to you. What's something that you think Michael Saylor and Strategy should do or you would like to see them do? Pretend he's not there.
Here's my opinion. I think that over time, when you look at things, I think that we're basically creating a Bitcoin-denominated financial institutions for the future, right? This is going to become, in my opinion, the new type of central banking system, right? You're going to have a massive one in each jurisdiction. They're going to be the largest, and you'll have smaller derivative branches that'll expand over time. So I think the natural progression, if that thesis ultimately plays out, is what does a bank offer today? If we're going to create a global monetary system that's Bitcoin denominated, you have to be able to issue the exact same kinds of products largely that we see today in the markets for consumers and institutional investors to use that we use with traditional finance. So we're going to see lending and mortgages and things of that nature over time. But you have to have enough Bitcoin in stockpile to be able to do that, to make that effective. And I think that's step one. That's what we're going through right now and we're seeing over the last couple years is the aggregation of the Bitcoin, holding it, and then the innovations in financial products that actually merge with the traditional financial products in the existing banking ecosystem is what's going to evolve.
Ed, I'll answer that question, but I'm going to flip it upside down. And it's rather than be critical and tell him what he should do better, I'm going to emphasize a couple points that I think everybody should take note of. And so, one, I would say you hear him over and over and over being laser focused, single-minded focused. And the problem that everybody has is doing too many things. In a private conversation in Prague, you told Alexander, you'll probably reach $1 billion, $100 billion, $1 trillion, but you probably won't because you'll probably try to be a conglomerate and you'll take your eye off the ball. And so this single-minded focus, and most of us try to do too many things, and so I think about that. I would also say, while certainly we haven't seen mainstream media be very favorable, there's also a massive misunderstanding. But to his point, not only has he gone out and shown the model, he's out there constantly trying to educate the world, changing the name of the company, teaching the strategy to everybody for us to follow, cooperation, collaboration, but also education as well. And so I would say rather than trying to tell him what he should do different, I think we should all take note of those things. And so whether you have a background in insurance like Jeff, and maybe insurance is your thing, but for each of us to follow what that thing is that we have, be single-minded focus, educate, collaborate along the way.
Michael, you got 2 minutes. Close it, Michael.
The question is, what would you do better? No, I'm joking.
I think I've talked enough. Next question.
Hi, thank you, Michael, and everyone here today. What an incredible day of knowledge and wisdom and passion as well. I'm a part of the team that is recently launching 21millionstories.com, and we're launching Hollywood-level TV film production for the Bitcoin Treasury space in particular. And I wanted to ask, when you envision the world that you imagine 10 years from now, what kind of TV film content, education, or entertainment do you imagine needs to be out in the world?
It'll be digital, it'll be interactive, it'll probably be AI driven, and it'll be personalized. You know, at some point, I think that all of our education institutions go away and you get like an AI professor that teaches you whatever you want that's better than every professor that ever lived. In fact, it's a combination of every professor that ever lived. And I think at some point the movie becomes a walk-through world. And at some point, all your entertainment becomes personalized. And we can see it happening right now, but I think a decade from now, we'll be blurring the distinction between personalized entertainment and personalized education, which is a good thing.
Thank you, Michael. Thank you, everyone. We will see you in January, and we will see you at PubKey in about an hour. Thank you for coming.
Thank you.